Hello, good morning and welcome to Buy Now, Sell Now with me, Varun Hiremat, and making a very special guest appearance is veteran anchor Mobina Kapasi alongside. So good morning to all our viewers and to you as well, Mobina. Nice to have you on BNSN. With that being said, let's get a move on with the headlines for this morning. A hope rally on the back of vaccine news seems to be what's cheering markets today. Indian markets are now at a 4.5-month high as the Oxford vaccine news has lifted sentiments and Nifty firmly above 11,000. Coming down to some earnings candidates which should also keep the market fairly buoyant today, and those specific indices and counters. So we're talking about Bank Nifty mainly, and then the FMCG index, as we have Axis Bank, Bajaj Finance and HUL, which are all going to be putting out their Q1 numbers. So some pretty big index weightage going to be announced today as well. We also, keeping it with results, are going to cheer SBI Card on the back of their very strong Q1 performance that we're going to talk about later. Then the next big chunk of news today comes out of divestment drive. So Modi government's mega privatization drive gathers steam. Inter-ministerial consultations to identify strategic and non-strategic sectors. Banks and insurance to be among strategic sectors, and this will be obviously involving the privatization possibly of the PSU banks. So ET Now first reported this to you, by the way, on the 15th of July, so we're ahead of the curve on that. And finally, as far as headlines go, vocal for local. Zoom to set up a technology center in Bangalore, and Zoom to hire from India for their tech center. Mobina.
Okay, thanks Varun for that. Well, yeah, I think the big headline today has got to be the fact that the equity markets have got themselves perched at a 4.5-month high. We are back above 11,000, back above 11,100 in fact for that matter. So that strong momentum continues. Maybe the vaccine news is something that's really lifting sentiment. And of course, on the other side, you do have your own set of skeptics as well that are saying that there could be, in all likelihood, a short-term correction that's, waiting by on the anvil. But for now, of course, cheer for the bulls of the Lal Street. But when it comes to the COVID pandemic, unfortunately, it's not all that cheery. Let's run you through the big headlines on that front. First up, the ICMR and the centre have asked states to ramp up on COVID testing across the country. In corporate news, Indigo now will be mulling laying off 10% of the workforce. Remember, aviation as a sector has still not fully opened up, especially when it comes to international airlines. And in positive news, Oxford's COVID vaccine is showing some positive results. This is in the second set of trials. The Serum Institute will be applying for Oxford's vaccine trials. And it's not just Oxford, even UK's Pfizer and BioNTech vaccines have been displaying safe results, this too in their second trials. The Health Ministry has warned that usage of N95 masks should be without valves. Sikkim, meantime, has rolled out a 7-day complete lockdown. West Bengal is ordering a 2-day complete lockdown for each and every week. In global news, the EU leaders who have been in a huddle for some time now are nearing talks on a stimulus plan. It's been going on for the last couple of days. This one definitely would be one of the longest talks being held by EU leaders. And finally, the WHO has said a speed search is on for the COVID vaccine.
Okay, and as I mentioned earlier, when ET Now first reported on the 15th of July that there was a privatization drive coming up among the leftover PSUs, let me clarify, the ones that have not been merged into any other entity yet. Ruchi Bhatia was the first to break this story then, so let's bring her on board today to discuss the latest developments. So take it away, Ruchi.
The Modi government's mega privatization drive is in the works. Remember, it was on the 15th of July that we told our viewers that the government is going to identify banks as a strategic sector, which means that in the long term, the government will retain only 4 to 5 key big banks, but look to privatize the rest of them. In fact, we're given to understand that as a first phase of the privatization, the government is going to identify some of the weaker banks like Bank of India, Central Bank, Punjab and Sindh Bank, Bank of Maharashtra, among many others. In fact, we're given to understand that at least four PSU banks will be in the fray for privatization, and this list is only going to increase in the days to come. It's an important story. It's a news break that we first brought to you here at ET now on the 15th of July. We're going to understand that not only banks but insurance sector will also be identified as strategic sector, and besides that there are many other sectors that are in the fray. For example, the oil and gas space, the fertilizer space, power space. In fact, we're given to understand that besides the 4 to 5 key entities in these areas or key PSUs in these areas, the rest all will be a part of the privatization drive of the Modi government.
All right, Ruchi, thank you for that. That's now the entire story with respect to privatization really gathering steam. Ajay Sharma broke about, BPCL. We had Ruchi talking about a Concor and a BPCL, and now, of course, banks are, in the eye of the privatization storm. Okay, well, moving on. Zoom, this has become a household name. It's something that has seen an immense increase in the number of users, especially during this lockdown. It has caused the company as well to list at spectacular valuations, and now acknowledging the whole vocal for local movement in India, they've decided to set up tech centers right here in India that will be manned by Indians. My colleague Chandra Srikanth, who interestingly, of course, did have the very first, or rather conducted the very first interview with Zoom's founders, now joins us on the show. Chandra, what does Zoom want to invest? What is the size of this tech center, that they're planning to set up?
Right, days after we interviewed their top management, they have announced a technology center in Bengaluru to underline their commitment to India. Now, we did ask them on the specifics what the quantum is going to be, but they did not specify an amount. However, what they did say is Zoom is going to invest in a technology center here in Bengaluru. They are looking at R&D, DevOps, IT operations, business operations, and they are going to start hiring for these positions very soon. So if you are an engineer who has expertise in any of these areas, good news, because there are going to be jobs that's going to be created here in Bengaluru. Now, apart from this, remember Zoom currently operates data centers in Mumbai and Hyderabad. They are planning to expand their data centers here. They also spoke about the usage that they are seeing in business users, how that has improved, and they named some of their India clients as well, the likes of Crisil, Religare, ICRA, WNS, and even IM and others. They also spoke about discussions with the government on security, that they have assured them about that, and that they are hopeful of an optimistic outcome. We of course have to wait and see what happens. But mum's the word when it comes to GeoMeet. They just said that they are used to competition, but no obvious references to the fact that both of them seem to have a very similar user interface.
All right, thank you, Chandra. Let's now, I believe our guests are now ready, maybe not Kunal, but Ashish Maheshwari is from Blue Ocean Strategic. So, good morning Ashish, welcome to the show. You know, what I want to bring to light is, I don't know if you had a chance to look at the latest Akash Prakash memo which was put out today, talking about worrying signs in the market. And, we're now going to start having Q1 earnings, and assuming the market doesn't fall, the PE ratios on a trailing basis are definitely going to move up because there will be earnings tapering off broadly for most corporates. So what are you advising your investors? Are you sitting on cash? Are you sitting on the sidelines? Or are you fully participating and believe that there's just too much momentum right now to kind of sit this one out?
No, in our view, though there are bright chances of earning tapering due to COVID, but a couple of things which are contributing to this bull rally in the market. First of all, global markets, if you see overall, they are participating big way into equities and metal rally. So in my view, like this, chasing global markets will keep Indian markets also in same queue. And another thing is, as there are not too many options among the Indian investors to put in money, so liquidity will keep on chasing quality stocks. And this is what's happening right now also. If you see in Nifty also, only few stocks are going up, and where there is quite visibility of earnings. So IT stocks or some of the PSU stocks, oil and gas related stocks and FMCG stocks, I think they will keep on driving this rally. And BFSI particularly, which contributes almost 24-25% weightage in Nifty, will remain on subdued side because from banking and NBFC side, I'm not expecting those kind of numbers which will be given by IT and FMCG and pharma, etc. So in my view, selected stock and selected sector-wise rally will continue.
Okay, great. So you're of the view that liquidity is going to really move the market as long as a flight, as well as a flight to quality. So those names should keep doing well. With that being said, would you like to leave us with any picks or any particular stocks that are looking exciting to you today?
Yeah, a couple of small cap ideas I have identified today, and they are into 40-50 rupees range, and they have a potential to give almost 50% upside in next 1 year. My first pick is Sri Digvijay Cement. After the robust numbers from ACC, I think mid-cap companies into cement space are also going to give good returns. As far as Sri Digvijay Cement is concerned, this is a Gujarat-based cement company with 1.2 million ton plant capacity near to the port also. And now, as the change of management has happened, so True North Private Equity is the owner of this company, and Mr. Anil Singhvi, who was CEO of Ambuja Cement, is now at the helm of the affairs. So we have seen this company, stock already doubled in last 1 year, but in my view, 50% upside still remains pending. And again, reason is this is a debt-free cement company, so pricing power is very high compared to the peer set. And if we see the last quarter numbers in March, they did a profit of 23 crore, which was full year they did 56 crores. So now onwards, they are going to see a lot of traction in their earnings. And this is the reason why I've selected this stock for your viewers. Another stock which I like is PTC India. Again, a PSU company, and few triggers are there. First of all, till 31st July, they are going to invite a bid to sell their NBFC, from where they are expecting 1,000 crore kind of realization. Also, they are in process of selling their renewable energy business. Another 1,000 crore they may get out of this. So 2,000 crore rupees they can expect in FY21, with a market cap of just below 1,500 crores. And they are also in process of making one exchange with Bombay Stock Exchange, where short-term energy can be traded for duration of 1 to 7 days. And also they have a very hefty dividend payout policy. So last year they did paid 5.5 rupees per share dividend. And they give generous dividend in form of 50% of their profit they pass on to investors as dividend. So once this 2,000 crore rupees will come, I think this year dividend yield is going to be phenomenal. So from this level, I see virtually no downside risk, and upside can be up to 75 rupees in this year.
All right, so those are the two recommendations coming in on the fundamentals. Well, while we wait for Kunal, let's do one thing. Let's take on board some questions and queries then. And our very first question is coming in from Nageswar Rao. He says, please do suggest And all right, you know what? We have Kunal Bothra as well joining in on the show. Kunal, before I move on to the query, I just want to get in your take as well on the equity markets. So we are in a short-term uptrend. There are no two ways about that. But the question is, do you think that there is perhaps a correction looming somewhere, lurking around somewhere in the not-so-distant future? And, while we're at it, if you could suggest some stocks as well that viewers could, sort of trade in to ride this market momentum.
Mubina, I think the markets are still going through a period of uptrend. There are some strange behaviors which have been spotted in the last 2 days, and particularly on the data point which I've been mentioning since yesterday, particularly that the put call ratio on the Nifty is at a much elevated level. It was at 1.64, 1.66 levels yesterday, and today I think on the monthly PCR, just I think some time back, it hit that 1.8 mark. So these are extremely overbought territories for the put call ratio, and generally indicates that a reversal could be due anytime over the next few trading sessions. So traders can hold on to their long positions, but you have to adhere some very stringent amount of caution over here. So I think in that regards, maybe the momentum could continue for a couple of days before the markets could start for some bit of strong reversal. Now I would suggest mixed bag of trades over here, one buy and one sell. The first one is about Escorts. The stock is in a very strong momentum. We've seen rural focused stocks behaving in a very strong and upward kind of a trend. Escorts is one of the the similar stock in that space. Would suggest a buy with targets of 1188, stop loss 1136. The second would be a sell on Godrej Consumers. I think the stock has plateaued over the last 1 month. It just has been in a range of 20-25 point band. I think 595 is the support for the stock. For 695 is the support for the stock, and closer to 725, you see a lot of resistance coming into the stock price. So it's been trading in this 20-25 point band for last few weeks, and I believe that could be a chance that the stock may go through breaking of this lower end of the band. So sell on Godrej Consumers, targets to be kept at 666 and stop loss at 704.
All right. Okay. Thanks a lot, Kunal, for that. Well, let's get back then to answering questions and queries that you guys have been sending in. Our very first question, like I, just flagged off earlier, Nageswar Rao says, asks our experts for an entry-level price for FDC. You could call this one a small cap name in the pharmaceutical space. Been a little quieter compared to the other names that we've seen in the healthcare space. Ashish, anything that you'd like to recommend on an FDC?
Already we have seen stock from the lows of 175 appreciated by almost 100 rupees in this rally driven by pharma sector. And FDC, if you see fundamentally, like they are having very good brand portfolio also. Like ORS, what they are having, they are the world leader in oral rehydration solution. And along with, they are having very strong presence in vitamins and food supplements also. So along with their other product range, which almost every company is having in gastro, ortho, ophthalmology, etc. But in my view, in COVID times, companies which are manufacturing vitamins and food supplements are going to continue to do well because they are generating a lot of sales. So FDC, in my view, you can enter at some correction, say 250 rupees. But only challenge is the slow and steady. So though you will not have any downside from there, but upside is also kept because they are consistent performer per se. So in my view, you can add this stock at 250 level, and in 1 year time frame, you can expect 325 rupees.
Okay, all right. So that's the recommendation on an FDC. Ashish, I think, is largely saying that at these levels, it's okay to buy. Kunal, what about you? Anything that you're observing on the way the charts, have been moving for an FDC?
So I think again a very similar kind of a chart. I think what Ashish said, more or less very similar. I agree to his views as well. That the stock looks to be quite decently poised. I think it's just that the entry point could probably be slightly more better. And the stock has a tendency of coming back almost after 2 or 3 weeks to its 50-day moving average and trading below it for maybe a couple of days before it manages to see a bounce back. So assuming that this would be an uptrend for the stock, which could probably last for maybe another couple of quarters, then even in that regard, I think the stock has a tendency of coming back to that average. Currently, the 50-day moving average is placed at I think 253 or 254 on the spot levels for FDC. So we can start buying now, but I believe that the stock, since it has a tendency of coming back to its 50-day moving average, you should keep some funds on the sidelines. That if the stock comes back to those 250 kind of levels, you should look to average further at those levels for a target of 300 plus over the time frame of 6 months to 9 months at least.
Okay, with that, FTC has been sufficiently discussed. Let's move forward to query number 2, which is from Vinita Malani of Kolkata. And is it a good time to buy the Bajaj twins? Please share outlook ahead of earnings. So, Ashish, let's come back to you. You spoke about liquidity driving select stocks, and a flight to quality. So I'd say the Bajaj twins are like the HDFC of NBFCs, if you want to call them that. They have high capital adequacy, no funding issues, low moratorium numbers. So given what we've just seen with a franchise like HDFC, where growth has been prioritized over asset quality, because right now moratorium's on, so no one's going to disclose NPAs. So given that, we have time on the asset quality front, and if Bajaj twins can deliver growth, do you think it's still prudent to invest at these levels, or are you looking at it more cautiously?
I like to wait for some correction to buy Bajaj Finance and Bajaj Finserv both, though I like both the stocks. First of all, let's discuss about Bajaj Finance. Their moratorium, like what you were talking, it has come down to a low of around 15 to 17% from the peak of 27%. Besides this, their lending pattern, if you'll see, if you see corporate lending, they lend to only companies which are A-rated and above. At the same time, they are primarily lending to two-wheeler, three-wheeler, and consumer finance side, where the risk is quite diversified, because your loan typically you work as towards 10-15,000 rupees for consumer durable to approximately 2.5-3 lakh rupees if we say three-wheeler per se. But in my view, stock has appreciated quite a bit from 1,800 to almost 3,400 now. So it will be prudent to buy such a stock only in some correction. From there, though they bounce back fast, at the same time, the downside risk is also limited. So I'll not advise to buy this stock at 3,400 to 500. In my view, 3,000 to 3,200 will be a good entry point. As far as Bajaj Finserv is concerned, again, the stock has given a handsome return, and last quarterly numbers were bad on account of a lot of fall in their equity investment portfolio, which won't be there in this particular quarter. At the same time, insurance premium delinquencies were there, so growth was not there. But in my view, insurance is something now everybody is going to look at it. And if you see today's newspaper, again, the term insurance premium, etc., are also going up now. So there will be some rush now to buy term insurance policies also, which will benefit again Bajaj Finserv. Like both stocks can be bought, but only at some correction.
You like it, but you're advising caution given the run-up. Kunal, leaving fundamentals aside, just purely looking at that chart, what would you advise?
Well, I'll also advise a wait. So these are good chart patterns on slightly medium-term time scale, but because of the last 2 months of very steep run-up and very less amount of correction or a significant amount of correction in that kind of a time span, generally expect that the stock could probably go through either a sideways lull or a sharper correction in that regard. So I think closer to 3,000 for Bajaj Finance and very similar levels for Bajaj Finserv as well is where you should look to try and take entry. I think your time horizon has to be from a longer term view, and provided the market conditions remain stable, what we've seen the last few months.
Okay, great, Kunal. Thank you to both of you gentlemen for joining us this morning. We've come to the end of the query section of the show. Time to slip into a quick break, and plenty lined up when we come back.
Welcome back. You're watching Buy Now, Sell Now on ET Now. India Bulls Housing Finance. That's a counter we'd like to talk about. The June shareholding patterns have been released by companies, and it's a very interesting observation. India Bulls Housing Finance has seen Axis Bank hiking its stake by more than 1%. That was not the case in the quarter ended March. Let's understand the entire context of this increase in stake as it stands. Remember, India Bulls Housing was in focus last quarter, because of similar reasons. My colleague Vivek Iyer, who has spotted this observation, now joins us on the show. Vivek?
Well, one of the stocks that is in focus today is India Bulls Housing Finance. Remember, this stock has been in focus. A lot of ET Now exclusives have been coming away as far as India Bulls Housing is concerned. We've spoken about how there could be a likely management change, management rejig. We've spoken about how PE funds could infuse capital. But this is something that has come out of the blue, not really expected by market participants. So in the latest shareholding pattern that India Bulls Housing Finance has uploaded onto the exchanges, there is a very unlikely name and a very surprising name that makes its way and pops up as far as the shareholding is concerned. Now remember, what you have to keep in mind is that a shareholding pattern of public shareholders is only named when they own more than 1% stake in any particular company. So at the end of June quarter, Q1 FY21, you're actually seeing Axis Bank hold close to 1.13% stake as far as India Bulls Housing Finance is concerned. Now, remember, now since it has crossed the 1% stake limit, it appears on the shareholding pattern. You don't know earlier how much they held, but we looked at the shareholding pattern at the end of Q4 FY20, and there, the shareholding pattern doesn't reveal the name of Axis Bank. So it appears as though they have at least increased their stake, if not a completely new stake. So greater than 1% stake for Axis Bank, and it actually is quite surprising. There'll be questions asked, especially given the fact that Axis Bank will come out with its numbers today, and there will be questions asked as to what exactly is the nature of this particular investment, whether it's a pledge increase or a pledge revocation, and these are the questions that will be posed to Axis Bank today at the press conference post the results.
All right, very interesting. Axis Bank buying a stake in India Bulls Housing, and not via invocation of pledge, as far as the report by Vivek goes. So that's a positive sign for sure. And talking about creeping into shareholding patterns, we have the big bull Rakesh Jhunjhunwala, who's now seen to enter the Indian Hotels shareholding pattern in a significant manner. Avan joins in with details on that.
Well, big bull Rakesh Jhunjhunwala checking into Indian Hotels, if you will. As per the stock data, Rakesh Jhunjhunwala holds about 1.05% stake, or that's 1.25 crore shares of Indian Hotels as of June 30th. So clearly, the big bull is giving his stamp of approval, if you will, or expressing conviction in the stock of Indian Hotels, which is the owner of the Taj Group of Hotels. Now, remember, the company has been on a track for strong growth as per their Aspiration 2022 plans. The company has been improving their return ratios, their debt equity ratios, opening new hotels as well. Of course, the impact of the lockdown has impacted the company, as it has the entire sector. But we even interacted with the managing director and CEO of Indian Hotels, Puneet Chhatwal, who told ET Now that the company is well on track for their ambitious growth plans. They are going to adopt effective asset management as part of their reset initiative, as he described it, and he's confident that the second half from the October to March quarter, the company will bounce back and have strong cash generation. So that's the latest coming in on Indian Hotels, with Rakesh Jhunjhunwala picking up stake in the June quarter.
It's a very interesting segment as well, where Rakesh Jhunjhunwala has bought in. It's related to the travel industry, the leisure industry, something that many people had written down amidst this pandemic. But yeah, a 1% hike in stake holding, stamp of approval, if you would call it that. Thanks, Avan, for that. Well, let's now shift our focus to earnings. ACC delivered its second quarter numbers yesterday post-market hours. Let's go across to Vivek Iyer. Vivek, what's the verdict?
The stock in focus is ACC, and in fact the entire cement universe. ACC has delivered a robust and an operationally very strong performance. Now remember, going into this particular earnings season, expectations for the cement universe were that they would be, it would be a complete washout quarter given the fact that volume offtakes were something that were almost negligible. However, what has been seen, and it's quite remarkable, is the fact that up till April 20th, even though there was no offtake, for the remaining part of April as well as May and June, there has been resilience seen as far as both volumes as well as pricing is concerned. Volumes have gone down over 30% on a year-on-year basis. However, despite economies of scale not being seen, the company has managed to significantly improve its cost or operating cost per ton, and it has reduced operating cost quite significantly. The EBITDA per ton has gone up quite sharply on the back of the fact that operating costs have gone down as well as lower input cost prices as far as fuel is concerned. So again, when you're talking about ACC, the other important thing that you need to keep an eye out for is the MSA, or the Master Sharing Agreement, which is basically cost sharing or cost saving initiatives that ACC and Ambuja had initiated, and this is being seen, the benefits of which are being seen currently. In fact, if you're talking about ACC, given the fact that it trades at a discount to some of its large cap peers, around 8.5 to 9 times FY22 EV to EBITDA, at this point of time, most of the brokerages actually believe that ACC can see a valuation catch up, and that is why all of them are quite positive when it comes to ACC. The headline numbers, though, are a little disappointing when you're comparing it on a year-on-year basis, but significantly above the analyst poll, except for the revenues that were marginally below. But overall, very robust set of numbers, and markets are rewarding ACC at this point of time.
Okay, Axis Bank is going to be putting out its numbers this afternoon or this evening for Q1 of FY21, and all eyes are set on that one, and a lot of hopes too after what we saw with the HDFC result. Now the numbers are flashing on your screen, but I'll just repeat them for you. NII at 6,800 crores basically means it's going to keep pace with what we saw last quarter. YOY I'm not even going to look at because all banks are growing YOY. So YOY, NII is seeing a 20% jump, almost as if nothing has happened. Now, at the profit level, last quarter, we had a loss of nearly 1,400 crores. That's because Axis took a 7,700 crore provision, of which I think 5,000 or 6,000 was for COVID alone. So this time around, what brokers are saying is we're going to still see very high provisions, but not 7,000 crore, maybe somewhere like 4,000 crore plus. That's how we are still managing a profit here of 1,200 crores this quarter as far as brokerages are concerned. Last year's profit were around 1,400 crore. Now, the operating level, as you might imagine, because profits are stable, it's stable as well. 5,600 crore versus last quarter's 5,800. So there could be a mild tapering off. Remember, there's going to be maybe some lower fee income, some lower other income, because a lot of services offered by banks were not able to be performed during the lockdown period. So you may see some revenue loss there. And with HDFC, we saw the same thing. The other income tapered off significantly. So that's something to keep an eye out for. As far as operating margins go, NIMs are expected to come in at around 3.5%. That's again holding steady from last quarter, so no major decline. But if they outperform, like we saw in the case of HDFC, which beat its estimate, that would be great. So those are broadly the cues to look out for. Nomura believes the credit cost could come in at around 240 to 250 bips. Gross NPAs and asset quality isn't really worth a mention because due to the moratorium, recognition is going to be postponed to the next quarter. So even some of your slippages from the corporate book might not show up in this result. So we look at the asset quality more closely next quarter. I think this quarter the moratorium figures will matter, and then the growth is what most brokers are kind of focusing on. The valuation for Axis Bank is right now 1.1x, 1 year forward price to book. So significantly cheaper than an HDFC or a Kotak, although it is often clubbed in the same group, Axis and ICICI. And we have seen some action in that stock given what we've seen rolling up to earnings season. So looking like stable, steady state for this one. And of course, we'll know all the finer details this evening. Keeping it with financials though, Axis isn't the only one who's going to be hogging the limelight. We have Bajaj Finance, which is also putting out numbers today, and a highly coveted result, arguably more so than Axis Bank. Soumya is going to join in now with what to expect from those numbers.
Well, Bajaj Finance is set to report its Q1 FY21 earnings. Taking a look at what the ETNR poll sees it around, well, as far as the net interest income is concerned, we expect a growth of around 18% on a YOY basis to nearly 3,533 odd crore rupees. Having said that, the profit would witness a degrowth of around 18% on a YOY basis to 970 odd crore rupees. Well, this is only on the fact given the company mentioned in their Q1 FY21 update performance that the AUM growth has remained weak, which was at about 7% in Q1 due to the slowdown in the consumer loans. Well, historically, the company has seen growth of around 35 to 41% as far as the AUM is concerned. So this definitely is a little way below than what the company has usually reported, and this is all on the fact that the tough macro environment currently that the company is seeing is making them very cautious as far as the lending is concerned. The management has time and again reiterated that the maintaining balance sheet and liquidity is the current focus for them. Well, having said that, they also had guided for a spike in the credit cost in Q1, and in fact they would continue to focus on managing operating costs and maintaining liquidity on their balance sheet. That's what the focus area for the management has been. That's what we already know from the Q1 updates that the company had given some time back. In fact, they also said that a good aspect is that the AUM under moratorium has reduced from 27% in April to 15.5% in June, and this definitely tells that the collection is seeing some amount of pickup. Apart from this, they also added that they'll continue to remain conservative. They're considering additional accelerated provisioning to strengthen their balance sheet. Well, having said that, we are looking for management commentary as well on the rural revival and the demand scenario that the company is seeing. What has been the update and uptick in collections as far as July is concerned? Has there been some pickup or not? Outlook on asset quality is particularly something that we're keenly watching out for as to what are the kind of asset quality trends and the NPA trends that the company is seeing, and lastly the kind of margin trajectory that they would see going forward.
All right, Samia, thanks a lot for that. And finally, we also have HUL, which will be delivering its Q1 numbers. And I think this will be particularly important. While it's not an apples-to-apples comparison, Britannia did exceedingly well. So now all eyes on HUL. The other big FMCG bellwether, Vinny Motiwala, joins in with the ET Now poll. Vinny?
HUL is to post its Q1 FY21 numbers, and this is the first quarter that the company will be reporting its numbers after the merger with GSK. In terms of numbers, we are expecting the revenue to be at around 9,900 crores and will decline by 2%, while the profits are expected to remain flattish at around 1,775 crores. Now, margins, we are expecting the margins to be contracting by around 100 basis points and will stand at around 25% versus 26% on a year-on-year basis. Now, what are the other factors leading to this set of results? One, firstly, the volume growth that has seen a decline of around 12 to 15%, 14-15%. In this range, we're expecting the volume growth to decline. And this is the first quarter after many years that the volume growth will be seeing such a significant decline. So that is something we'll surely watch out for. In terms of the overall core business of HUL also is being quite tough, and especially with the demand for personal care, home care segments, ice cream segment, all these have been severely impacted due to the lockdown and the consumer sentiment being weak for these segments. So in terms of personal care and home care, we are expecting a decline of around 12 to 13% in terms of both these segments. While in terms of the overall food and refreshment segment, we are expecting it to see a rise of around 5% as consumers are still going in for packaged food items, and the trend over there is quite high for consumers buying these products. In terms of profits, profits are mainly benefited by the lower effective tax rate cut, so that is keeping the profits flattish at around 1,775 crores. Also, in terms of margins, the margins are seeing a decline of 100 basis points, but they're supported at these levels mainly due to the lower crude prices as well as decline in ad spends by the company and cost saving measures, which is protecting the margins at these levels, and we're not seeing a sharper decline in the margins. Now, other factors that we'll watch out for will be the management commentary on the GSK merger and what are the synergies that they're seeing in terms of outlook for the rural growth as well as what are the demand trends they are seeing, and overall the commentary on competitive intensity, any down trading seen by the company as well as the raw material pricing outlook, what is their thought over there is something we'll watch out for.
Okay, that was Vinay with what to expect from HUL, another highly coveted result, which we'll soon know how they fared. Switching gears a little bit, though, to banking. Earlier this morning, we caught up with the Chief Executive of IBA, Sunil Mehta, and there was a lot to discuss: the possible mergers among the leftover PSUs, privatization drive, one-time restructuring, recapitalization for banks. So much going on in that sphere. Let's listen into what he had to say.
Three basic reasons. One thing is, the entire banking landscape is going for a transformation, a great transformation. Earlier, there was basically concepts of brick and mortar branches, and all deliveries of the banking products were physical mode. People will go to the bank for obtaining an FDR, for depositing the money, and for all type of activities for a purchase of a draft. Gradually, the model became phygital, where basically part of the activities, especially into the payment space, started happening digitally, using of internet, making payments through card, but that ratio is still, although it is growing, but not to the full extent so far, which is yet to catch up. The moment this entire space is digitalized, then the next phase will be digitalization of the loan verticals, like delivery of the loan products. So when that segment is also digitalized, the banks will have to undergo a lot of transformation in terms of their physical presence, in terms of their branch network. Where they have 20 branches in one particular area, they may be good with only 5 or 6, and remaining they can relocate the manpower, they can relocate into the different areas like wealth management, into the area of marketing, into the area of newer type of services, counseling. So what I mean to say is the entire banking landscape is going for a transformation, and the merger will provide them the synergies. Because if 4 banks are merged and the 4 banks have got n number of branches at a one particular point of time, then at least they can be reduced easily, because they are almost in the geographical proximity. So there will not be any customer inconvenience for those who are going for physical transaction, and it will save a lot of cost on establishment cost in terms of rent, electricity, as well as the manpower redistribution. This will also provide a scope to the merged entities in expanding to the newer areas, because everywhere there are some new colonies are coming up, new real estate is being built up, there may be new industrial areas being built up. So whatsoever manpower, whatsoever resources can unlock from this type of synergy, that can be redeployed into these areas and more specialized new areas. So I think it is a very welcome move. It's a very right and timely move. Besides providing them the strength, the balance sheet strength for taking larger decisions, this will provide them operational synergies also.